My name is Darson Grantham, and on this podcast and video, we kind of just talk through the last week in real estate, and it's going to be a different topic every week, but we'll do basically comps, we'll do recent conversations we've had with investors, and the intent of the podcast video, I got to figure out what I should say there. The intent of this content is simply to educate folks on Des Moines real estate, Iowa real estate in general, what investing looks like to them. So I'll hand that over to Jared.
And that's one thing I wanted to tie in as well, is that understand this is going to be all content based for you locally in our Des Moines, in our Iowa market. This is not content for people across the country. So you're going to get very specific localized knowledge. Darson's going to come at it from an example of investing in single family houses up to small multifamily, duplexes, fourplexes. And I'm going to come at this from kind of a high level range of apartments. If I haven't introduced myself yet, I'm Jared Huseman, president of the Catalyst team, part of KB Commercial Realty, based here in Des Moines, Iowa. We're a team that specializes in multifamily investments in our Des Moines Central Iowa market, as well as the state of Iowa.
Yep. And when he says team, so Jared has his own business, I have my own business also. So although we love talking back and forth, we are separate teams, if you will.
Yeah.
We both definitely have different specializations, although the lines blur quite a bit.
And I want to also preface as well is that Darson and I both come at this not just from an agent perspective, but where we're going to add a little bit of fresh flavor is that we both own property and have owned property in the past. So unlike other agents who might just talk to you about what the books say or what they've done, we actually have a personal ownership experience in owning houses and in flips and investing in multifamily,
Yep.
and we actually can speak to it on that high level analysis of ownership. So we understand where you guys are at from that level.
Yeah.
So what have you been? So let's jump into it, Darson. So I mean, have you seen any comps that you think are worth noting in the last week for houses?
So the week we are recording this is January 12th, 13th?
It'd be January, today's the 17th,
today?
and it's the week of the 20th.
Yeah, the week of this January 17th, so of 2022. I've had probably 15 buyers reach out to me this week looking for properties to buy. Now, with the New Year's, and we've had this conversation too, everyone has new goals, want to buy 100 properties in the next year, and so it's something that buyers are reaching out about. The problem is right now on the Des Moines market, I did a search for Polk County in general, Polk County, and there's 10 total multifamily MLS listings. And so the business that I work on is primarily MLS and off-market, the DMAR, Des Moines Area Real Estate Association, MLS and off-market. Jared in the commercial world has kind of a different radar of properties, and I'll let him explain that. But when I say on market listed, there's only 10 properties, that is crazy. It's half of what it normally is.
I think tying into that as well, for Des Moines right now, what we're seeing, looking at CoStar, looking at LoopNet, looking at Crexi, which are the major three investment platforms for apartments and commercial real estate, we really only have less than 5 properties actually listed.
Yeah.
And what I'm getting a lot is buyers reaching out saying, is this property still available? And if it is showing on any of those sites, it's probably not. If it's more than 3 or 4 days old and it still shows active, that's probably because the agent hasn't had a chance to update it yet and show it as pending or sold. So we're seeing very little product right now in the market. We closed out the year really strong. I know we're a little bit late in terms of comps for the last 2 weeks, but for Des Moines, we saw over $500 million of sales volume for apartments in our market in 2021 for an annualized year. To give you perspective, in 2020, we had a record-breaking year of 220 sales million volume, and we had 500 million last year, so almost 200% growth. So that kind of shows you some of the comps. It's not a last week comp, but it is a last year comp. And to give perspective, that's what we're seeing in multifamily.
So I didn't fully answer your question on the comps. I kind of went into the buyers and what comps look like. Last year, we put 2 offers in on properties, lost both of them by over $10,000. And they're small duplexes, not small, normal size 200,000-ish duplexes on the south side. And so there are buyers, there are many, many, many buyers out there for you. Or that are looking for a property. So that's, comps wise, it was a $200,000 property. listed at 197 and we offered 215 and lost it. I think rents were 850 and they probably couldn't have been bumped up to 950 to 1,000. So.
Sure. And for comps, I would say for multifamily, what we're seeing right now, I'm going to pull again mostly from last year's averages just to give us kind of a flavor. But we were seeing 77,348, give or take, on average price per unit. That's as a market as a whole. That's including suburbs, so that's including the Ankeny, the Grimes, the West Des Moines markets. But that's kind of a flavor of that. We're seeing about $100 a square foot as a price for most of that B and C class product. This is a very 1970s grade C class, maybe B class product as well.
Gotcha.
It's kind of what we're seeing on that price point. We're seeing rents of those kind of apartments right now anywhere from $750 to $800 a month, depending if it's one bed or two bed.
Yep.
So again, we're kind of seeing that 1% rule of the price per unit as to the rent. So we're seeing $750 a month in rent. We're seeing $68,000, $70,000 or so price per unit, give or take, kind of just off that 1% rule for the apartments.
Okay.
What are you seeing for investments in houses for that?
If you're looking at single family, you're below the 1% rule without question. There's definitely most of the rental inventory is also first-time home buyer inventory, right? So investors understand that I could either continue to rent or I could roll my equity by selling it to a residential single-family buyer and get much more than I could if I sold it as a rental in many of the cases. So you really are seeing quite a bit of turnover from those cash flowing rentals that were bought in 2009, 10, 11, 12, and investors are putting them on the market with the facelift and they're selling. So if you're looking at single family, I mean, your rent to price ratio, if you buy $150,000 house, it's probably going to rent for $1,300 in most areas of town. If you wanted to get up to the $1,500 a month of rent, which would be a nicer property in Des Moines, you're probably looking at $200,000 purchase price. But I mean, $200,000 with a $1,500 rent, whatever that percentage ratio is.
Sure,
that's kind of what we're looking at. And that's what I've seen it hasn't changed over 2021. I don't have a ton of people looking to get into single family rentals unless they're true burring it, right? They're buying the property, rehabbing it, refinancing it, renting it, right? So I don't anticipate that, that percent to get any more favorable for the investor.
Right. And it's funny you said this actually about what you said about investors, because just this morning I was going through my list of recent comparable sales for apartments in the last 3 years. We saw 157.4% price appreciation from 2018 to 2021. But the interesting thing you just said is that going through those recent sales, it's amazing how many investors that actually since sold already. They've already flipped it twice.
Yep.
So it was sold in 2017, 2018. That same buyer has already come out and sold it again for even more money than what it was there. We're seeing a lot of that action in the market. It was really surprising. Probably, I would say it got a good 10% of the properties have already traded hands twice the last 3 years.
Which is, as real estate agents, when we're trying to find listings for our buyers, that's a niche that a lot of folks don't go after because they see, they just bought that property 3 years ago. There's no way they'd want to sell it.
Right.
When what the market has done over the last 3 years, it's actually a very good time for them to sell and just trade up into a different property. So.
Right. I think that, though, also brings into the question big time of kind of what's driving our market right now, which is the appreciation. Right now, investors are actually able to make money, make returns on depreciation. I mean, they're able to buy it, and sometimes with a lot of work, with major renovation, sometimes with light renovation, sometimes with no renovation, they're able to sell it for more in a couple years. And I think that really ties into what's driving Des Moines market right now, and I would say a way we've never seen before.
Yeah.
Like, I think this is, from my experience of owning property now since 2009 in the Iowa market, the last 3 years have really been the first time we've ever seen investors buy purely for appreciation and less about cash flow.
Yep.
Thoughts on that?
And it works.
It works,
right?
Yeah.
Like, I think they did it accidentally, or at least we went to lunch or dinner the other day, and we laughed because people bought 3 years ago, and we're like, wow, they totally overpaid for that, and those are the ones that have rolled that over, and we're like, well, dang it, that was a good idea. What were we missing, or what are we missing?
Right. So that's always the question too. Is that I think we talked about this actually this the other day. Is when you are one of those investors who has bought and been able to sell it higher, just understand: did you really make profit because you were that good as an investor, or do you just get lucky and buy into a market with all the, tide rises all ships? Not saying one or the other is better. Some is better to be lucky than good, but just be able to sit back and recognize that if you are one of those investors who has equity, who has sold even since then, be able to step back and say, did I actually do this? Did I force the appreciation in there, or did I just get lucky? Right. And the reason I say that is because you need to learn that for future investments, because it's one thing to be lucky once, but nobody's lucky forever.
Yep.
So make sure, ask the questions of yourself of, did I really win this appreciation through my own efforts?
I think it's just what went wrong, and would that have cost me it, given my initial numbers, my initial outcome. I thought it was going to comp at 130, and it ended up comping at 170. I made 40 grand.
Right.
So essentially, I broke even on my first set of numbers. Right. So, however you run that, however you run your numbers, think about that. If you should have lost and you didn't, awesome. But don't, make sure you know what you did to could have done wrong, I guess.
And on the apartment side of things too, understand that we've seen a lot of rental growth in our market, more than we have seen previously. But a lot of apartment owners are running their rent growth at accelerated rates. So did I really sell this property because I raised rents, or just because cap rates compressed so much? And if I did raise rents, what did I actually do to obtain that higher rent value? And then again, asking yourself too, again, how's those rent compared to the rest of the market? Just ask the deeper questions. Don't just say I was able to sell this and I got lucky.
Right.
Again, it's all about learning this so you can do better next time. Again, if you made money, this is awesome. I don't want to fault you for making money. We all want to make money. But let's just make sure we're asking the right questions.
Yep.
I think this ties really nicely into what we're going to talk about today, which is the theme is the syndication we're starting to see. We've seen syndication has been a really common theme the last few years, especially with the growth of gurus teaching how to syndicate property, especially in the multifamily world. We see a lot of people teaching syndication tactics and techniques. Just today we were talking about syndication. So what do you think about syndication? What are you seeing, Darson?
See, I have not studied it for myself. So one of the things that I don't want to say pride myself on, but if I haven't done it, I'm probably not going to recommend it. Regardless. Now, yes, I've sold properties that I have not owned, but I have not sold properties types that I haven't owned, if that makes sense.
Okay.
I just haven't. And so syndications are one that I haven't studied myself.
Right.
I listen to a lot of podcasts. To be honest, I usually skip when it comes to syndication because I don't find that it fits what I want to do or the folks that I work with.
Sure.
The deals that I'm selling are usually at least under $2 million. I'm really not finding stuff and helping buyers buy above that $2 million mark right now. I enjoy it, I understand it, but syndicators want things above that, right?
Right.
And so what I do have the conversation with is my buyers when they say, I have the option to spend $50,000 into this syndication, or I can spend $50,000 buying a duplex. What do you recommend?
Right.
And so that's the consulting point of view that I've had. And really it comes down to, and my favorite thing to say is, do you have more time or more money? Right?
That's a great one.
Do you have more money or do you have more time?
Yep.
And there's some bar graph, not even bar graph, line graph that meets to where it fits your resources.
Right.
I am someone that right now I have more time than money to just throw into syndications.
Right. That makes sense.
At some point I will dabble with that so that I can learn and be a little bit more educated on that. So I guess that's my front point.
So it's funny you said it actually, because I want to tie in. So a couple of things we should preface as well. When we say syndication usually means the pooling of money from multiple people to do a deal. Now the reason this is different than a partnership is because a partnership is usually 3 to 5 people, maybe a little more, but usually less than about a handful of people as a partnership. Syndication, there's 2 types of syndications when you are investing in syndication. There is the GP, the general partner, and the LP, the limited partner. And generally speaking, those are 2 very different things. So most gurus are teaching people now about how to be the general partners, the GPs. The GPs are the ones that find the deal, source it, underwrite it, run it, management, everything else. The LPs are the ones that just invest purely for a passive return. So what you just said is interesting. This is why I want to bring it up. is my advice to my clients. I think the time versus money issue is like it's a great way to say it. The other way I say to a lot of my clients, especially ones who want to become GPs, is go be an LP. If you really want to learn how syndication works, go invest money as an LP and tell the general partner flat out that I want to learn how to do this. And generally speaking, depending on who the GP is, they may or may not like that. Some may say, I purely want limited partnership and I don't want you to have questions. Others may say, I welcome this. But that's a great way to learn how syndication works, is to become an LP in the deal, just so you can learn what good ones are like and what bad ones are like. And I will say that when you are looking at syndications, if you are going to be a limited partner in it, understand that there are some really good syndicators out there who have had a lot of success with this and have made a lot of money at it. There are also a lot of bad ones out there that have not done very well with it. We have a couple in our market that have come and done this. And ask the question that we just talked about earlier, which maybe this general partner that wants to do the syndication has a great track record, but if you look into their track record, maybe they just got lucky.
Yeah.
So really be asking the questions right if you are going to invest in LP, and really just have the tough conversations about, is this really a general partner? Is someone I believe in, someone I trust in? Do I trust their numbers? How have they done things? Really just ask those deep questions. And then again, understand what are your goals for investing in that syndication. Is your goal, like you said, to create just money because you have no time? Or is it to actually learn? What's the goals for that syndication, I think is really important if you are looking into these things.
Yeah. One of the things that when you are syndicating too, and I found this pretty interesting, is many investors that have come to me that have the money to invest in a syndication, but they want to buy properties themselves, is the tax advantages of buying real estate yourself.
Sure.
Now, I've also, and again, I haven't done all the research, and you can probably correct me if I'm wrong.
Right.
As an LP in a lot of syndications, you can negotiate for different tax advantages,
yeah.
right, inside of that syndication. So don't just stay away from syndications because you want the tax advantages, because I believe you can build some of that into the syndications.
Right.
Just know, I believe most syndications are trying to roll over every 3, 4, 5 years.
3 to 5, yep.
So at some point, you're going to have to put that money somewhere.
Yep.
And so whether it's another syndication, you better get that lined up. If it's the same folks, great, just continue to use them.
Right.
If it's a property, you need to start doing your research for when that end comes, so you're not paying large capital gains.
Well, see,
right?
that's the thing to think about though too, is by its very nature, syndication tends to be owners who are moving in on properties every 3 to 5 years. Generally, rule of thumb is 5 years, maybe 7, maybe a couple of years less or more, depending on how. But rule of thumb is 5 years. So you need to begin going back to what are your goals? What are your goals for investing in this too? And again, looking at this. The other thing I think we should talk about too, when I'm talking to my clients about syndication versus pure ownership themselves, is whether you're going to become a partner or you're going to syndicate. Generally, I have a rule of thumb, maybe this isn't the right way, but I generally have a rule of thumb is the only reason you have a partner is to get somewhere where you can't go by yourself. So for example, if I've got $100,000 to invest, I can't go buy a $5 million property. So let's do syndication, let's partner on it, whatever it may be, to go buy that big property. But you only syndicate and partner to a level till you get to the next level up. There's just no other reason.
Yep.
Otherwise, just go do the deal yourself. Because at the end of the day, you have less control in syndication. Even if you're a general partner, you still are having to answer to your LPs because you are taking their money to invest. So you do have a boss. It's called the people that have with the money. And you might have 10 bosses or 20 bosses. That's not always easy to judge. So understand that when you are going to buy property by yourself, you are beholden to, generally speaking, one person, yourself, or a partner, spouse, whatever that might look like. So I generally like to ask the question of anybody, whether they're doing partnerships or syndication, is this going to help you get to the next level of your career, and do you want to get to that level? Because if you're purely looking at just saying, hey, look, I want to invest the money and get a return, why not go do it yourself? There's just no reason. I mean, why? Why would you go have a partner when you don't want one?
It would be the work though, right?
Yeah. Well, that's true, but there's management companies for that now nowadays, where you could hire a management company to take care of your duplex, take care of a fourplex, take care of some apartments. Again, not saying that we can have another debate later whether good managers are good or not, and if they're ever going to take care of it like you will. That's a whole other subject outside of this conversation. But at the end of the day, why would you ever do something that you have partnerships? I mean, it's like saying you're gonna get married just to get married and have no reason behind it. I mean, and you need to, and that's how I look at it. I mean, like back to earlier, I said, you know, if you're gonna syndicate, ask the questions of the GP of who you're syndicating with. Same as you get married, you ask your spouse, you know, do you want kids? Where are we gonna live? You know, do you want to buy a horse or not? Easy.
Getting personal.
So we have to ask these questions though, and that's just the point is that at the end of the day, it's easier to have conversations with yourself, make your own choices for yourself and your family than it is through partnerships.
And so you're basically saying on the LP side, right? Like
on the LP side.
On the LP side, why would you syndicate, or like the only reason you would syndicate is if they're doing something that you can't or don't want to spend.
Well,
the time
and I'm
doing,
going to go
right?
I'm on the other side of that too. GPs as well. If I'm a general partner, I got to understand. This is the thing too. We don't take enough credit for. There's a lot of gurus out there that teach this syndication and how you're gonna be the person who owns 5,000 apartment units. I hear that a lot. I hear goals of I want to own 2,000, 5,000, 10,000 apartment units. And generally speaking, the answer is you don't actually. You are a general partner and you might own 10% of that, but the investors own 90% of that. Now here's the issue with that is that when I say as a GP, oh, well, I own 4,000 units. Well, first off, I don't. I only own a portion of those. My investors own the rest, same as the bank owns a lot of it. And second, let's dive into what a GP looks like. Okay, now you have potentially tenants who don't want to pay their bills and want to destroy your property. Not saying they always do, but in theory, that's what happens a lot. So you're stuck between that rock. Then you're stuck between that rock of investors demanding a return. So the life of a general partner, of a GP, of a deal is not always the most fun because you're stuck between tenants all day long and managers who want your money to fix up properties, stuck between investors who are demanding a return. That's a very thin needle you have to weave through. You have to find the balance.
It sounds like a general partner is like a property manager.
Yeah.
That also gathers funds.
Yeah. At the end of the day, your job is to raise money and then manage the money by talking to talking to managers as well. And from my experience, the good general partners out there understand what it's like to own properties. But there are some general partners out there that I've experienced and seen who have never once owned anything but a big property, so they don't understand how to fix up property. They don't understand how to raise rents. They just demand from their White Castle, hey, go down and raise rents, and I want it all done by tomorrow, and I want a 90% success rate, and we're going to raise rents $200 in every unit.
And that's what they're selling the LPs on, that they're going to do, when in reality, like, that's not actuality.
Right. And they've never actually been the one managing the property. They never actually have been the ones physically doing the work.
Yeah.
So again, I'm not saying it's right or wrong. There's some GPs that have had major success doing this, but understand that you have to look at the GP and who they are. Have they owned property before? Have they built up to the level they need to be? And why? What have they done for that? Cool. I think it's just a question people need to ask a lot more. And as a GP as well, going back to real quick GPs, if you're a general partner and I say, let's say I go out tomorrow and I find a 400-unit apartment complex, and let's just say in theory I could buy it myself. Why would I do a syndication on that deal if I can buy it myself? Yep. Now the only reason I would syndicate that deal if I found a great deal on a 400 or 100-unit apartment complex is if I want to preserve my capital to go do more deals, because my goal is to own 1,000 units or 2,000, whatever it may be. But understand, I could also own 100 units, 400 units, whatever this case may be, totally by myself individually, and have 100% of the upside. Yep. So again, it comes back to what are your goals as well, but let's also look at that being a general partner isn't as glamorous as everybody likes to say, and let's also break down when people say they own 10,000 units.
That's my big thing. I would agree that like a lot of people own, you listen to the Bigger Pockets podcast, and I own, 1,800 units, whatever. And I haven't done the research, but I think there is some clarifying questions to ask if you want to figure out who actually owns them. What does that look like? It's no small feat either way.
Yeah.
But I mean, it gives a clout that maybe is not reality.
And I think the other thing too is let's really ask the question back. I love it. Clarifying question there is that if someone says I own 1,800 units that I've syndicated, the other question is how much of that money have you put down? Yep. So what's very common, again, it depends on who you are, what gurus you are, is that if I'm going to go out and syndicate a deal, let's say 100 units, and our market right now it's about $7 million. So the down payment, 20% rule, usually about 25%. Let's use 20% for basic math. That's $1.4 million I need to raise. Now, some GP, some syndication groups will try to go out and raise $1.4 million of the $1.4 million needed. A better syndicator, more experienced one will say, I need to raise $1.4 million. I'm going to put in $140,000 of my own cash to get the front up, or I'm going to put up $280,000, whatever it may be. So,
and that's 10 or 20%.
Yeah.
Is that what you're normally seeing?
Yeah, whatever it is. Yeah, I mean, maybe it's more. Maybe it's a GP that says, I really believe in this deal. I need to raise $1.4 million. I'm going to put in $400,000 because I believe in this deal a lot. So ask the questions like if someone says, I own 2,000 apartment units, my question to that is, okay, what's your ownership level of that, and how much down payment do you put into all that? Because if they just put no money down and own 2,000 units, you could potentially just build up a whole house of cards that's going to collapse very quickly.
It gets the skin in the game.
Yeah, again, and skin in the game is going to answer everything too. Yep. So how much do they believe in the deal? And again, generally speaking, a good syndication group, a good general partner, usually will put in 10, 20% of whatever the raise may be themselves to show they have their own capital at risk. There are some syndication groups, though, that don't put in any money. And you need to ask the questions, why?
What about, so my other question on syndications, and you'll know this because you deal with it much more. In Iowa, what percentage, like two questions. How do syndicators work with brokers? Agents, right? And then what percentage of deals are syndicated versus not?
Okay. So diving into that question, syndicators work with brokers and agents just like any other owner would. I will say from an agent's perspective who does a lot of multifamily in this as well, buyers who do not syndicate are going to rise faster in my top 5 rankings or my actual active buyers.
So people that you believe are going to close on a deal.
Yes, I would much rather send a deal past an individual owner who says I'm going to own this free and clear myself, or I might need a partner with it, but I'm going to be majority owner. I'm majority say. If someone comes to me with the pitch of I'm going to syndicate this deal, if you make an offer, it's still going to fall lower in my wheelhouse as an agent, because I'm at the end of the day, when you do need to syndicate, it means you need to raise money, and I need to have belief that you're going to have experience raising that money. So you're going to fall less unless you have a great sheet about your facts, about how much deals you've closed, your experience level, et cetera, et cetera. And even then, I'm going to have more clarifying questions. We can talk about that another day. In terms of how many deals have been syndicated in our market, that's a really good question, and I don't know the answer to it.
Like give me a range.
Yeah.
I know that there aren't that many deals done, but what was there, like 70 last year or something?
There were 69 transactions, give or take, last year.
So like what percentage-wise? Is it 20%, 10%, 75%?
See, that's the interesting question, though, because I would say at least, if you talk about deals that have partners involved, I would say that was probably a good half of deals have partnerships involved of some kind. Because a lot of people have partners.
Yep.
And at the end of the day, this is actually ironically you say this way, but a REIT is no different than a syndication except it's public rather than done on a 5-year term. At the end of the day, a syndication is no different than private equity. Private equity versus the capital market, which is just the Wall Street stocks. So we saw some big REITs come into our market and buy. That's technically a syndication deal because they're REITs.
I would call that a true syndication. I mean, that's...
Yeah, I mean, at the end of the day, it's someone pulling money to buy this, and it's a REIT that's buying it. So if you wanted to look at that, I mean, you would say probably 20% of our market was done through either REITs or syndication. Okay. Last year, probably 14 to 20 deals. And ironically, the REITs who did buy last year, we saw 14 transactions with the average price tag of $25 million. So 14 transactions last year drove $330 million of our $500 million plus sales volume.
That's wild. Yeah.
So, and those were REITs buying up portfolios or major syndication. We have a couple of major syndicators in our market that have been here for a couple of years now that have really expressed interest in growing and have done so. So I would say a good 20% are done through syndications. And again, but the ones who are doing it have vast experience in syndication, whether it's long-term REITs or whether syndicators have been in the market for many years. In our market are playing with it as well. Again, it's really hard to become a syndication group. Don't let everybody think it's just as easy as they pitch it.
Right. And so to wrap this up, like we don't have a preference pro against syndicators. No. It's irrelevant to us. We just get a lot of these questions about syndicators. Yep. And so it's fun for me to pick Jared's brain because he would work more with syndicators, but my buyers are always asking, should I join a syndication or should I not? So it's a little selfish of me to ask him these questions,
And
but
you know what though? But selfish speaking here, and I'm going to pitch right back to you here too. I'm not saying I have all the answers. I'm actually better asking just questions. But I actually think, and the way I came up in the business as well, and I think you as well, is I came up with actually doing the deals, actually myself. So if someone called me right now and asked advice, should I put money into this deal as a general partner or a limited partner, or should I go do this duplex house? I'd actually recommend going to do the duplex house first. Get experience, actually own it yourself. If you want to become a general partner later on in life, that's another story. We can talk about that. But I'd actually recommend go doing the deal first, because you'll have a lot more wisdom when it comes time to be that GP and you want to get to that level. Again, my advice is only just go do the deal yourself. Don't have a partner unless you need it. And if you are going to be an LP, only do it because one, it's the return, or two, you're trying to learn how the GP is going to go.
Yeah.
Now, as a final caveat, we can talk about later on, we can go into the details later, is if you are going to be an LP, ask clarifying questions about the return.
Yeah.
A lot of these returns, they promise 15, 20%. Most of those returns are what they call IRR, internal rate of return. And if you know how internal rate of return works, it's like pro forma. It's
worse than pro forma. It is pro forma, but it's like
pro forma.
It's
pro forma and IRR are both synonymous with bullshit.
Yeah.
At the end of the day, pro forma is bullshit. It's all what could happen, and IRR is all based on selling the property in a couple of years. And if anyone knows they're going to sell that property for in a couple of years, they're lying to you, because no one knows where the market's going to go.
Especially depending on if it's like a large multifamily,
right,
or if it's commercial, right? Because those commercial deals, man, if one of those come up and like you have 3 of your 5 tenants, their leases are up in 3 years, and you're trying to sell in 5 years, to say, hey, we know what the market's going to be for commercial units of this size in 2024, and we're selling in 2026 to get out, like.
See, this is why I call bullshit an IRR, and I've always hated it. I like cash on cash. I like ROI. Yeah. You can look at those numbers, but pro forma, again, to an extent, you can learn to tell good form and bad formas. But IRR, I call bullshit, because to say I'm gonna sell a property for more in 20 years is easy. Say I'm gonna sell a property more for 10 years, that's easy, because again, you have a long enough time horizon. To say I'm gonna sell a property more in 3 to 5 years, that's just plain ignorance, in my opinion. So
it's easier at 6 months, right?
Yeah.
I know at 6 months,
yeah,
maybe not more, but you know what it's going to sell for.
But the world gets very, very hazy when you look out 6 months to 5 years.
Yeah.
I mean, usually you can look at 6 months out and say, here's what I predict is going to happen, or I can predict out what's going to happen over the next 10 years. Like we've talked before, if you bought property 10 years ago in Des Moines, you'd have bought in even 2007, 15 years ago, the height of the market, you were a genius.
You were dumb then, or dumb in 2 years after that, but a genius today.
Yeah, but look, if you'd have bought in 2007 and tried to sell in 2012, you'd have had to hold it up until 2015 to even get back to that first number here. So that would have been an 8-year hold, 10-year hold. So again, I call bullshit on these IRRs that we're seeing a lot. And I'm not saying that there aren't good IRRs out there.
Or it won't work. Like it could be right, but to bank your money to. And maybe it just comes down to diversification, right? You put a sum of money in this, and you're like, I think it's going to work. If it doesn't kill me. If I break even, fine.
I think at the end of the day, what I would say with any syndication group, if you are going to invest in it, is just always make the assumption that one, it's going to take longer to sell that property than what they estimate, and two, you're going to make less return than you expected. It's kind of like a flip, right? Yeah. Like you always assume a flip is going to go over budget and to take longer on your rehab.
In worst case, you got to rent it.
In worst case, you got to rent it, right? So that's the thing about with doing syndication groups. Whether you're syndicating in an office or a retail or in our case, apartment complexes, and you are going to be the LP in it, just make the assumption that one, it's going to take longer. Two, it's going to be less return than you want, probably. If you go with those assumptions off the bat, and you still feel comfortable, then do the deal. And if not, if you're not comfortable with what they're not offering, then don't do it.
Yep.
So
ultimately, you're in control of who you wire your money to, right? I mean, that's what it all comes down to. But
I think that's an important thing to always remember. To anybody out there watching, always remember that you are in control of your own finances and your own investments. So don't ever let anybody talk you into it.
Yeah.
And that can be a syndication group, a GP, even agents.
Yeah, I was gonna say a sale.
As agents. Yeah.
The number of times I've told someone not to buy something, and I work with a fair amount of out-of-state investors, and they're like, usually the agents are like, yeah, you should buy this deal, and I mean, right now, there's some duplexes, quads on the market that I'm like, it can be a good deal, but I'm not promising anything. And so, yeah, don't get sold.
That's the thing I gotta say. I mean, I think one thing you and I, once we get along so well with our clients, our investors, is because we kind of have a reputation, I think, now of telling it how it is. And
life's too short.
Yeah, and I tell my investors and clients exactly what I think and what I feel, and I'm not going to sell you on something that you don't want to be sold on. Because one mistake I made in my investment career, for anybody out there watching, is there was a couple times agents sold me on flip houses that I could do this under budget and get it sold no problem, and my ARV was going to be super high, and I listened to that, and guess what? I lost money.
Yep.
So I've learned, do your own research, and at the same point, if you own property too, never let an agent convince you to sell. Understand that you own that property, you have control of that property. So if you don't want to sell it, then don't sell it. I mean, no one can talk you out of it otherwise.
Yeah.
Make the best decision for yourself.
Cool. Well, we'll wrap this up.
Yep.
We plan on doing a lot more of these. This is kind of honestly our first one.
Yep.
We've been riffing like this for probably a year since I started.
Oh, a year and a half, 2 years, yeah.
About real estate investing and working with buyers and sellers. So we enjoy doing it. And call to action.
I guess I can say for call to action, if you want to see more of this, just come out and hang out at the KW office here in West Des Moines, because this is the things him and I talk about daily to his offices all day long, is we're just talking investments because we just love it.
Yeah.
I mean, I think you and I both just enjoy talking real estate and investing. So,
yep, I'd say, in brass tacks of call to action, get on both of our email lists.
Yep.
Jared sends out a really good commercial quarterly update and definitely annual.
Yep.
My newsletter, I send out kind of what's going on, what properties have sold, what the return could have looked like if you bought it, blah, blah, blah. Also have a weekly coffee meeting that we have in Des Moines. So if you are local and want to roll in, we have it at Smoky Row Fridays at 7 a.m. So that'd be the two call to action things that I'd say.
Yeah, I would say just reach out, get on our list. We're working on beefing up our list right now as well to even provide more value for anybody on our list.
How many people are you trying to get on your list?
Trying to get my list right now, as many as possible.
What's the number?
What's the number? Right now, we're at 670 or so active subscribers, give or take the day. I'd love to get 1,200 people, so double that. So double it. But we're going to try to provide really good content. That's the thing that I want to say. We do as my team, we do digital and we do physical at all, because we want to hit you both ways so you can get it whichever format you prefer. But we're really working on this year, 2022. Holy crap, almost hit the wrong year. 2022, we're going to beef up our content to be really relevant for you, what you want to hear. So you mentioned the quarter report that I've done for years now, very well read, very well subscribed to. We're going to beef that up. We're going to start doing weekly updates like we're talking now. We're going to start breaking down comps for everybody to see on a weekly basis. So that way you're not waiting 3 months for comps. You're going to get it to your email inbox the day it happens.
That's awesome.
Or the day after it happens. It's pretty close to that. So you can actually look at what's happening on a weekly basis on our market, not on a quarter basis. And our website's going to have a lot more information as well for some of the research for the market.
Awesome.
So
cool. We'll wrap this up. Again, my name is Darson Grantham, real estate agent here with Keller Williams in Des Moines.
And Jared Huseman here, president of the Catalyst team, part of KW Commercial Realty here in Des Moines.
Awesome.
Cool. We'll see you guys next week.
See ya.